You said that Bitcoin was going to hit a high of 110,000 and retrace to maybe 70,000. Well, bang, you hit that on the head.
So I'm slowly but surely thinking that we're trying to carve out a bottom here in the month of March. It's difficult to make too much of what happened over the weekend, but if we get above 95,000, which is right around where we peaked over the weekend, I'll be very confident that lows are in place and we likely go back to new all-time highs, meaning we get up above that 109,000 that we saw back in the middle part of December. S&P itself has been dragged down by technology, which has been a notable laggard, but a lot of that has been concentrated in the Magnificent Seven, aka FANG, and not really broader technology. We have seen a little bit of bifurcation. Sentiment right now is very pessimistic, so it's a great time to be a buy and hold investor and cover one's eyes, hold one's nose, put your hands over your ears and just buy and not worry about it.
Global Money Talk is delighted to have Mark Newton, Managing Director and Chief Technical Strategist of Fundstrat Global Advisors with us today. Mark, thank you so much for joining us on the show.
Thanks for having me back. Great to be here.
So the first thing I have to say is, in our last conversation, I think it might have been in November time, you said that Bitcoin was going to hit a high of 110,000 and retrace to like maybe 70,000. Well, bang, you hit that on the head. 110, the high. And looked like we're going back down to where your low was before the Trump post over the weekend.
Right.
So what are you thinking about Bitcoin now?
I'm a bit more encouraged. I think it's a much better risk reward here than it was a few months ago. There's still a tremendous degree of correlation, positive correlation between many parts of crypto and the equity market. And so both of them have been largely range bound in recent months, but the cycles for Bitcoin do bottom in March, and that was something that I looked at late last year as Bitcoin was peaking and said there could be above average selling pressure for reasons that really nobody was aware of. So sentiment certainly had gotten off the charts bullish, very, very optimistic. Many people were getting notifications on their smartwatches that Bitcoin was 100,000. That was obviously a huge sign of optimism. But just that it had gotten near-term overbought, and a lot of the cycles suggested it could start to pull back after its move. So I'm slowly but surely thinking that we're trying to carve out a bottom here in the month of March. It's difficult to make too much of what happened over the weekend, but if we get above 95,000, which is right around where we peaked over the weekend, I'll be very confident that lows are in place and we likely go back to new all-time highs, meaning we get up above that 109,000 that we saw back in the middle part of December. So, it's a very volatile market, and if many don't have the tolerance to manage the swings, everybody's got a different risk tolerance and time frame of their own investment. But I'm optimistic. I join Tom Lee in his own optimism that we're likely going to be quite a bit higher this year. I came into the year just suspecting there'd be a little bit of consolidation and turbulence, and I think most of that has largely played out.
I know it was an amazing call. Again, you said, it'll probably happen. I'm hoping it happens right after the end of the year, so
right.
We could take profit without the tax implication. And
right.
Really, it just
right.
unfolded exactly the way you said it.
It's better to be lucky than good, as they say, right? So no,
just take credit. That was an amazing call.
Thank you.
That was an amazing call. You said something about sort of like, the sentiment had gotten really overly bullish. Everybody was getting their, I don't have a smartwatch, but their notifications when it hit 100,000. How do you measure the sort of bullish sentiment in Bitcoin and sort of in other things that you track?
It's a great question. I tend to have a number of different proprietary type indicators that I use both for equities and also for crypto, less on cryptocurrencies, but more. I look at a lot of the traditional sentiment polls for both retail and institutions. AII, American Institution for Investment Professionals, Association for Investment Professionals. Yeah. So that's more of a retail-based poll. I also look at fear and greed. I look at the equity put-to-call ratio. I look at the overbalance of volume on the downside versus upside. Are there more people are selling than buying, and what is it doing to actual market breadth? And sometimes on severe downturns, you see a tremendous amount of volume on the downside versus upside, and oftentimes that can be a sign of capitulation that we're closing in on a major low. Crypto has different ways of tracking that, and some people you look at open interest, the hash rate, they'll look at the options market there, And so it all came together to suggest that we could be nearing a high at a time when nobody was prepared for it. There was a lot of great news as the new administration had gotten underway and was planning to come into power that would be very beneficial to cryptocurrencies this year, as well as a stepping down of Gary Gensler, who was a notable hawk for cryptocurrencies and somebody that many had found very difficult to deal with in the industry. So, by and large, I'm very positive now that with what's in place on the infrastructure side, it's more just getting a feel for when the trends actually start to bottom out, and that can take some time. But this weekend's developments were certainly a very positive step in that direction. I had said to Tom Lee, we're probably going to get to 75,000, maybe 60. We got to 78,000. I'm not one that's willing to take a lap just yet, but I think we're very, very close. So I don't mind dipping my toes back in the water for those that exited above 100,000 and thinking it's right to be in. I do suspect it's going to be a very good time from the spring into probably October of this year.
Interesting. And you say October because I guess that those last 2 months have historically been a little bit sort of profit-taking or a little bit weaker, or just the sort of
there are different cycles that run and different. Historically, the fourth quarter has been great for cryptocurrencies, but I sense that this year could actually be better in the time between now and the fall. So we'll see. I can certainly revisit with you when the time comes. But the bottom line is I'm pretty confident that we're getting near a decent trading low.
And you're sort of looking at Bitcoin, and one thing that does concern me a little bit is, and I didn't take profit above 100,000 simply because I didn't think my position was big enough and I didn't want to miss the next upswing. But one thing that does concern me a little bit is there seems to be, or certainly maybe it's just the past, most recently, concern or nervousness in the equity markets, and I'm wondering if that's going to prevent crypto from having a nice rally. So in the past, have you noticed that if the crypto will divorce itself from other markets and run on its own? Is that like sort of cyclic? In some ways?
Potentially they can. It's been unusual, honestly, the degree to which Bitcoin and like the NASDAQ, for example, have shown pretty positive correlation, and they're both seen as a sign of risk on in assets. So they don't always have to move that way. And so I would encourage investors to keep that in mind for those that are looking for diversification that in the short run, I think both of them are to some extent tied to interest rates. As long interest rates fall, that should be actually quite optimistic, and it should be a good sign, constructive for cryptocurrencies as well as for equities.
So just taking a step back and moving away from Bitcoin for a little bit, and not that I'm a fan of the man, but Vladimir Lenin said something that I thought was really interesting, and it was, there are decades when nothing happens, and there are weeks when decades happen, and it feels like sort of Trump 2.0 feels a little bit that way. I mean, the man's been in office again for 6 weeks, and it's been an absolute whirlwind of things happening. In terms of what you're seeing in the markets, in terms indices, sentiment, has anything struck you in this, the first part of this Trump restoration?
I think it's been an interesting time, full of lots of sector rotation, lots of, intra-sector turbulence. But honestly, when you say, lots can happen in a short period of time, you look at the S&P 500, and we're only about 10 points from where we traded back the day after the election on November the 6th. So it's proper to keep in mind that, we came from 61.44 down, we're right around 59.40. These were the levels we were at back in early November. The market has literally had 0% net change since that time, despite the swings. People have gotten arguably bent out of shape and concerned about what potentially could happen with regards to the tariffs, but we certainly don't have any real firm idea as to how all this is going to play out. And if it's similar to Trump 1.0, many of the things that are being announced simply were bargaining tools and did not result in a meaningful rise in inflation, which is what investors are hearing. And we're seeing interest rates have gone down now for 6 straight weeks. That's the longest period in 5.5 years. So people's fear, I think, is misguided. And if anything, it has not had an abnormally damaging effect on the stock market. The stock market literally made all-time highs 8 trading days ago. That was February the 19th. So we're down about 3.5%. Sure, it's awful for some people that might be overly invested in technology and are not as well diversified, but 8 of the 11 sectors are up about 4% or higher for the year. S&P itself has been dragged down by technology, which has been a notable laggard, but a lot of that has been concentrated in the Magnificent Seven, aka FANG, and not really broader technology. We have seen a little bit of bifurcation where semiconductor underperformance has given way to outperformance in software and other areas of tech hardware. So tech on its own has been fine. It's just important for investors to understand the differences in the rotation, and that it's just really important to take, try to cover one's ears and not let the news unduly influence your investing decisions, because as of now, the market has had very little technical damage to it. Long-term trends are intact. Meanwhile, we're facing a time of fear where, based on AAII data as of last week, the last time we got such a bearish number, the percentage bears was 60 last week. The bulls were about 20%, so it's a 40% spread in favor of the bears. The last time we saw that was at the height of the bear market from 2021 to 2022. Prior to that was 2007 to 2009, where stocks had actually decreased 40 to 50% off their highs, and we had extraordinary bearish sentiment. So now we're seeing that kind of negative sentiment, but nothing has happened in the overall stock market. It's just fear that the media has created in terms of creating this narrative that something could be damaging, but the economy seems to be on good footing. And as we talk to Tom Lee, he'll say exactly the same thing. There are a couple more cuts now that are priced in the curve, but GDP data is fine. We've seen a little bit of evidence of the PCE data not being ideal, and some measures of inflation are still higher than we want to see, be it shelter, used cars, car insurance. Can that actually continue to grow at a 30% rate per month or per year? I doubt it. So I'm optimistic, thinking that crude oil is going to start to fall. There's questions about China's resiliency and their own comeback. That's going to serve to export deflation to the rest of the world. Those things are going to offset the fears about inflation necessarily rising quickly and how this is going to be so damaging to the broader market. As an investor, I don't see it. I think it's wise to just really ignore a lot of the exogenous events, and I hate to say that because there's some very real and unsettling things that are happening around the world with regards to wars and also tariffs and what's happening. So not to make light of that, but as an investor, none of that has really affected the broader market.
You make a good point, and that it was not very long ago at all that we're at all-time high. We printed all-time highs in S&P, right. But the market feels so moody. I think, as a technician, you can probably right. actually see that moodiness in the charts. Where I'm not really an expert, but I see the S&P 500, at least the cash, seems to have broken the uptrend a little bit and now going a little sideways over the past week or so, couple of weeks. But the market is just nervous. But it's very interesting that you bring up the point that usually they're this bearish at the bottom, and when people are this bearish and no damage has been done, maybe suggests that the market is a little bit more healthy than we think.
That's true. We're not seeing high put-to-call ratios. That's the one thing that would argue that we haven't really seen real capitulation. So there's not panic selling, but yet there's been an orderly type decline based on poor public mood that likely is going to turn out to be a buying opportunity. I'm pretty optimistic that the lows very well could be in place. And we haven't seen a lot of evidence yet. We've seen a couple days of rally now off the lows, but I'm pretty optimistic the S&P is not going to get down under January lows, and we should be en route, honestly, back to new all-time high territory, initially 6,300 and then probably 6,650 at a time when investors least expected. So keep in mind, retail sentiment is much different than institutional sentiment, who have a need to be invested, and so they're begrudgingly long stocks. However, with being cognizant of the fact that tariffs could eventually come into effect, and we'll all wait and see what happens. But the investing, there's still a lot of polarity based on politics. When you look at the first year, whenever you switch administrations, first year of a new presidential cycle, you do typically tend to see volatility in the first quarter of the year, just like we've seen. So February has been exactly as seasonality has expected. It hasn't been any real different in my view. So I don't think a 3% decline that breaks a 2-week uptrend is something to be concerned about. When you look at the 9-month trends from last year and or from 2023, they're very much intact. They're fine. And technology, to its credit, is something that's still, we've seen some, as I said, some bifurcation and a little bit of rotation in different parts of tech. But you have areas like financials that are doing extraordinarily well, and banks hitting new all-time highs, largely which has fueled most of Europe's rise with a declining euro. And so when industrials, financials, discretionary are all operating, showing above average gains that are outperforming the market, and technology has taken a little bit of a breather, that's not necessarily a time to think, well, the top's in, I'm scared because of tariffs and I'm going to take my money out of the market. Fear is that, is elevated right now, and stocks arguably are still in very good shape as yields have been falling lately.
In your experience, would you say that at the extremes, it's because you mentioned institutional and retail sentiment, that at the extremes it tends to be retail sentiment, which is more volatile, that actually drives the highs and the lows? Would that be an accurate characterization? Or
it's difficult to say that sentiment drives it. It's certainly present, and is one of the main things I think investors can utilize to have a greater understanding as to the inflection points in the stock market. You see cycles and sentiment and just basic trends. You do tend to see it drying up in the selling on the downside at a time when investors are very, very bearish. And you see the last people that are just unwilling to sell, but there are also very few buyers. That's what can create a bottom. It's not as if there's a handful of small investors that all jump in at the lows and buy stocks, and everybody's wondering why they did it or how they did it. There's really a misconception that they're actively people at the lows that are buying in large amount, and that's what makes the market goes up. I mean, it's certainly supply-demand is important, but it's really about a drying up of the selling on the way down, and also a drying up of the buying on the way up that causes markets to peak. And so sentiment is very important in that regard. When it gets too far on one side of the boat and everybody's bearish or everybody's bullish, we've seen CTA exposure having been drawn down after the election. People were concerned about tariffs, and institutions pulled back. The name surveys, which are what I use for institutions, they certainly are much lower than they were back last fall. So they're not bullish, but they're also not bearish. They're pretty much neutral. But it's more the retail sentiment that has just gotten so abnormally pessimistic. And a lot of that could be fear of Trump 2.0, and we're all aware of the potential for chaos. But there's also quite a few positives with regards to tax-friendly policies and deregulation that many companies are mentioning, and just the possibility that it could be a lot friendlier climate for business. And so I tend to view those overall as a big positive, despite the ongoing chaos.
Right. What interesting with AI today, I've seen on the package that I use, and it's not a fancy Bloomberg terminal. They've given me an option where I can select candles, but I can select volume candles. Then they give me the more volume it is, and you never really know if it's accurate, but the big volume is a fat candle. So you can see like fat
Right.
candles going up or fat candles going down, and I guess it's situational, but is it more? I guess it's more bullish if the market is rising with a lot of volume, rather than the market makes highs but the volume is very thin. Is that generally a good way to read them?
You tend to see a spike of volume at inflection points, particularly on the downside, where you see a rush of people to get out of positions. It tends to see volume spike. It's more people getting out of positions than you do a huge surge of volume at the bottom. But when you tend to see stocks bottom out and start to turn higher, it is a vote of confidence to see volume rise sharply as stocks are, potentially breaking out above former multi-day highs up to multi-week and multi-month highs. that's definitely a tool for the arsenal of most investors that they'd be wise to take a look at. Volume speaks volumes about what's happening in the market and with the individual stocks. And so when you get a feel for using candlestick charts on various time frames, be it hourly, daily, weekly, monthly, it really helps to put everything into perspective and really getting a feel for what volume's doing.
It's such a big change. I remember when I started in this market, but there was one gentleman, he traded the European currencies when they were still different currencies, and he was hand charting.
Yeah.
And now you click a button and you get all that information available to you. It makes the analysis more powerful, but in some ways harder because so many people can see it. Whereas imagine if you're a market technician 30 years ago, you could see things that people couldn't see. Now it seems to me it's a lot more available.
Price and time analysis is something that's been going on for hundreds of years, and you can use 1 unit of time for a unit of price. You can create point and figure charts that help to give one an advantage as to potential for the range of something going higher or lower. Everybody's got their own set of indicators that they find important. I think it is important to make use of trend lines, and when you do so, not only use arithmetic but logarithmic trend lines, and make use of mathematical trend lines as Gann used to do way back in the 1920s to get a feel for whether something, because it's all about energy, and that's what creates the breakouts themselves, and can make stocks go up or down in ways that fundamentals can't justify. And so, that's why Fibonacci levels sometimes can work very well. It's because price and time are lined up exactly perfectly. It's not just that there's a Fibonacci level and sometimes it works, sometimes it doesn't, and it's a coin flip. You have to get an understanding of how time is moving. If a stock goes from 0 to 100 in 100 days and then comes back 38 days and corrects 50%, that's much more important than if it's,
Right.
You get an example of how to use price and time analysis. So I have a lot of respect for the old people that do them with by hand, but none of us have much time to do that these days,
Well,
right?
you don't have to anymore, right? I think the guy was doing he was trading Mark Spain or something, and you couldn't get good data. But this is the 1990, early 90s, right? You couldn't get reliable data on Mark Spain, so
Right.
I think he did it by hand on graph paper.
Yeah.
And now, there's no more Mark Spain, but
Right.
you can flip it. You can look at so many different things.
Yeah.
So it's made people smarter, but I think it's made a lot of people smarter. So it might be, in some ways, the secret sauce is not as secret.
There's certainly a learning curve involved, and one has to take some time to study the indicators and how to draw the charts, and not just think that AI and software has given you a lot of fancy colors and that will help your trading. It might or might not, but there's some homework that we all need to do to understand how price action moves and realize it's not based on the Fed, it's not based on earnings, it's not based on the economy. One always wants to think that those are what's causing the market to move, but honestly, it's a combination of a lot of the shorter term cycles and along with sentiment that causes these market turns, and they're all mathematically related. It's just, as you say, it takes time.
There's a lot of nuance in it, as well as we've looked at different
Right.
markets over the years. I wanted to take it back a little bit to say, when the charts and the instruments that you're looking at, anything that stands out to you in the sort of short to medium term that's like maybe a chart that's on a knife edge, or something's about to break higher or break lower. Anything stands out to you that, over the past past couple of months, the beginning part of this year, which often can presage what will happen for the balance year? Anything that stands out like I want to keep an eye on this one?
Yeah, that's a great question. I look at the movement in consumer staples, which have suddenly started to trade higher for reasons that many don't understand, and that sometimes can be an early warning sign that the market's starting to adapt a little bit of a defensive tone. We're seeing this year's outperformers are concentrated in utilities and REITs, and some of the staples have beaten parts of technology, so that's interesting. It's not to the extent that I would say consumer staples are going to start to show meaningful outperformance. Similar, a move in some parts of healthcare has also been surprisingly positive and different than what many people suspected when RFK joined the administration. So we're seeing some pharmaceutical stocks that are showing really nice breakouts, and it's not all concentrated in the vaccine makers anymore. It's just various parts of pharma. So that is certainly all a very big positive. I would say as a negative, you do have meaningful trading ranges that have developed in some of these Magnificent Seven stocks, and stocks like NVIDIA, given its percentage within the S&P, can't afford to get down under levels like 113 without causing some meaningful damage to its own technical structure as well as to the broader market, given that NVIDIA is the largest holding. Other ones like Microsoft have been range bound for more than a year. But we know by experience that many of these stocks go into lengthy periods of consolidation, and at least historically, 9 times out of 10, all these patterns are resolved to the upside. And so we can't say that's necessarily going to happen this time, although I personally do view technology to be in good shape, and earnings have come in much better than expected this year. So investors, need to be paying attention to times when their favorite stocks start to trade range bound and might not offer the same degree of alpha as may others that are trading within maybe some of the other software sectors or some of the financials that might be in better shape, where one can make better returns in the near term if that's your area of focus.
Yeah, I know you used to be an options market maker in various places. Some of these names going into a range, do you see an opportunity to, I know some investors like to sell options for premium, and certainly in a range, the vol is lower, so you get less, but you probably can maybe sleep a little bit better at night if you've sold some options. Do you see an opportunity for, selling options for premium in some of these names that might be in a range?
Oh, 100%. I think particularly at the advent of 0-day options and weekly options now, one can certainly make use of that. I think most months on their long positions, as we see either abnormally sharp move, which then starts to roll over and might be going into a trading range, to make use of selling calls on some of their existing positions that might be interesting. I mean, implied volatility largely is still pretty subdued, but you do have stocks where it makes sense. Stocks like Tesla, for example, that are, the realized volatility and the implieds are both still on the high side given the recent decline. And to your point, stocks like NVIDIA and Microsoft, I mean, they've been a lot more range bound, conducive to more option selling in the short run. So that certainly can change, and it does change, but that's why one makes use of technical analysis just to see where these ranges are and when they're broken.
How do you like small to mid caps? I mean, I think for decades, it seems like, if we recall, they outperformed, and then recent years they've done rather poorly. How do they look, the small mid caps? How do those charts look? Or should investors be thinking about maybe reallocating a little bit if they're in the S&P and the Mag 7 are such a big part of it? And if they're sideways, are there better places to spread your money, so to speak?
I think there's a big difference between thinking about it and actually putting money into action. And the performance of small and mid caps in the last couple of years has been certainly subpar and not yet at a level that I feel has, that it's really actionable. So in the last decade, small caps have largely underperformed pretty sharply almost every year. There was a brief period in 2020, we had a very sharp bounce in small caps, but the larger trends have been very neutral, to say the least, and just relative charts of, say, IWM versus an equal-weighted S&P as a gauge. When I see that change, then it'll be time to take action and start to diversify more heavily into small caps and into mid caps. I do sense that's coming this year, and it should be like a second quarter or third quarter of 2025 event where small caps can start to kick into gear. There's a lot of questions regarding the viability if the economy is truly starting to weaken, and how tariffs will affect small cap companies, some that already do not make any money. But everybody thinks of this as being this hugely chaotic, turbulent time where we're getting all this selling pressure. I think that we're going to see a rotation back into technology. So I'm still a favor of owning S&P and honestly owning QQQ as opposed to RSP, or SPW if you're looking at the index, for a period of 3 to 6 months or longer. If you have a 2 to 3 week time frame, then I still think that we might see a bit more outperformance out of equal-weighted, only because many of these Mag 7 stocks remain very much range bound, and so that certainly needs to change.
Just moving sort of geographically a little bit, do you see any sort of, one of the things that the European stocks have had a gangbuster start to the to 2025 versus really, on a pretty flat in 2024, certainly compared with the S&P. How's those European stocks look? Is it sort of a flash in the pan, or does the chart feel like there's some energy behind it, and there's some value in that, for at least months, if not for the rest of the year?
That's a great question. I mean, I think the Stoxx 600 index is actually back at new all-time highs for Europe after having broken out of a very lengthy long-term base. The Euro Stoxx 50 is right at all-time highs right now, I believe from back in 2000. So I think a lot of this move started to accelerate last year as the euro started to drop, and I think that's not going to be the same case for 2025 into 2026. I think the euro and pound sterling and yen, for that matter, should all start to gain ground. The dollar looks to have begun what I feel is a pretty meaningful correction. So I don't sense that they're going to have the same degree of tailwind that really helps their stock market when viewed in say, euros, for example. If you look at the European indices and dollars, for example, and many of the popular ETFs that are have the highest degree of liquidity, EZU or VGK or any of those in the US, there's a marked difference between the attractiveness technically when you look in dollars versus if you look in euros. So I think it's interesting to mention that. Tough for me to ever suggest fading anything that's at new all-time highs. But at the same time is I think the U.S., the ratio at least of the ETFs to me suggests that the U.S. is ready to close that gap and likely should start to show better outperformance versus Europe in the coming quarters.
I want to shift a little bit to China, which is, had the Chinese stock market or the CSI 300, or I think they all probably look relatively similar. Sort of, weakness, and then late September, early October, you get a huge move higher, and then it's been sort of, what's the technical term for it? It's like a cone on its side. It's been sort of narrowing ranges. Do you have a feel for where, policy aside, but the energy of that chart? Is it, does it look like it will? Which way is it going to resolve, I guess is the question.
It's always tricky to try to give people answers on China because when you have a 50% move in an index over a period of a few weeks, it's all a question of one's time frame and how much you can afford to lose on the downside if it starts to retreat before it goes higher again. I like most emerging markets, and I would put China as part of that category. I mean, being about 30% of the EEM, for example. So as the dollar starts to roll over and retreat, that should be good for China. It should be good for Mexico, and it should be good for India. South Korea has shown a little bit of bounce, but it's still a laggard compared to some of the others. China has some real questions with regards to the durability of their rally just based on the economy. But to look at technicals, we've seen some very favorable breakouts in many of the leading, Chinese names, and the ones that are listed here, like Alibaba, for example, getting above 118 made that quite attractive to me. Has broken nearly a 2-year sideways consolidation that I find to be quite attractive. So I added BABA to my upticks list, which is my technical list of longs as of last month, because I think it can show some further intermediate term gains. So I think we'll probably have a window over the next 3 to 6 months where we probably can see further gains in Chinese equities, and a lot of that's based on the dollar and just potentially Trump going a little bit easier on China and realizing that the China's really it's in our best interest long term to be a friend to China and not be as harsh as maybe what the media suggests. So I think when Xi and Trump met a couple months ago, and it was widely suspected that they sort of ironed out an agreement where they wouldn't crush each other's economies and we'd figure out a way to make things work. So just plain and simple, I think it's right to have some exposure there because I think the dollar is falling, and that's primarily the reason. And I do respect the degree of short-term technical strength, and So if one can afford to buy dips, I think it's still a good place to be.
That's great advice. I mean, and I like your thesis on Alibaba, especially because they let Jack Ma come out in public. I mean, the guy's been in the penalty box for
Right.
4 years.
Right.
It's like 4 NHL seasons you haven't seen the guy. Right? So I think that's actually a good sign with sort of fundamentals line up with technicals, and that's when it seems like there's really good value there. So so BABA is something to keep an eye on. You talked a lot about the dollar, and I used to look at BBDXY, which is the Bloomberg Dollar Index. I thought that had better weighting than the DXY.
Right.
But you can actually get BBDXY on some on some of the services. So when you look at the dollar and the dollar's rolling over, give us an idea of how we should be looking at dollars. Is it the DXY? Is it a combination of dollar yen, dollar Swiss, and euro? How should we be looking at it to figure out what's happening with the dollar?
Well, I mean, to your point, you have to understand, look under the hood and see what makes up the percentages within the DXY. I think it's still a large percentage of it is euro, euro dollar, pound sterling, and also dollar, the yen against the dollar. So I think the yen likely is going to continue to rally in the months to come. It has begun a very sharp rally. We've heard from Ueda-san and others that inflation is still running comfortably above targets, and they did not address the move in JGBs. I think that was important. So it gives them the ability to be able to continue to hike, and I think they're an unusual case where the rest of the world is easing and they're hiking rates. But I sense that dollar yen can likely get down to probably the lows that we're seeing late last year, which would be a pretty meaningful rally still to come in dollar yen. I do sense that, and the euro and sterling even more so, I think both of those can really begin pretty meaningful rallies against the dollar. So it might prove short-lived. I suspect that the U.S. eventually will be back, and there's been a degree of underperformance in the U.S. compared to most of the globe, but I think that once we get a better feeling for the tariffs and the extent of that, I sense the dollar is going to start to push back higher yet again. So it should be short-lived, but for the time being, yields and the dollar are both heading lower. And I think that's been an interesting phenomenon because equities had correlated pretty positively with treasuries, and everybody said that yields are going to go above 5% right away as soon as Trump gets, the 10-year, as soon as Trump gets in office. And exactly the opposite has happened. They've been pulling back. So, it's a wait and see.
How do you see U.S. yields for, the first half and then the sort of the balance of the year? Because it really is a very, very sharp rally in bonds, and yields have dropped quite substantially. How do you see that?
I think this is more of a counter trend in Elliott wave parlance, like a three-wave decline in yields. And the first part of that has probably completed. We'll probably see a bounce, and then we'll see a further pullback that might take us into the summer. The back half of the year, I think it's probably likely we'll see yields move back up, and that could be also the same with the dollar. So I don't sense that we're going to be here for long. But yeah, the economy has been sort of all over the place, and really it's been, most of the economists have been puzzled as to, to try to make sense of this post-COVID type recovery where the labor market is still a lot of imbalance, where people have started to they're reluctant to lay off people, but the hiring is sort of frozen, and the working from home dynamic in the U.S., and now more and more people are being forced to work at home. Mortgage rates are at 7.5%, and it's causing a little bit of slowdown in the housing market. There are some things to be concerned about, but it's fascinating. I think. I sense that the economy, we went from a period of almost 200 basis points of Fed rate cuts being priced into the curve literally just last fall, and then that went down to 0, and now we're back up to 3. So to give you the sense of the roller coaster as economic, data has actually surprised to the downside in the last month, and that's caused more and more cuts to be added, which I sense is actually a very good thing for the stock market at a time of pessimism.
You mentioned Elliott wave, and that's interesting that you think this is a three-wave correction. Maybe I should go and take profit on my TLT because that's that thing gyrates like you wouldn't believe. It's like basically a 20-year yield, right? So maybe I'll take a little profit on that and see if I can reload. But so Elliott wave, I just want to ask for the benefit of our viewers. Elliott wave is a little arcane. Sounds like you're a student of it. Can you give just a brief, your thoughts on Elliott wave, when it's useful, when you have to be a little more careful?
Well, I think it's always useful. The question is having an understanding of your own time frame of what you're using it to analyze. For people that are day traders, you want to make use of very short-term 1 5-minute hourly charts. For those that are longer term, I get the most value out of just looking out over the next 1 or 2 months and seeing whether recent gaps comprise, third waves. The corrective waves are what is a source of real argument among many Elliotticians, and so I don't like to look at longer term patterns and say, well, this is definitely a 5, and this. I like to say, okay, what's going to happen in the next few weeks? And so you've seen Bitcoin, for example, carve its first 3-wave move up off the lows. If that turns into a 5-wave, that'll be pretty good evidence that Bitcoin has probably bottomed, at least for this time. We can go back to new highs. So I like to look probably a little bit of a shorter time frame and how I view them, but they're very, very informative. The more experience you have at measuring, looking at corrective waves, where they're very overlapping and choppy versus nice motive 5-wave movement. We have a 5-wave move up, a 3-wave move down. It's all on the basis of Fibonacci, 3, 5, 8, 13, 21, and it's all interrelated, and that largely based on the concept of phi, which is a building block of life, and it formed the basis of Fibonacci.
Right.
So it's all interesting. I use wave patterns as a way to come up with projections of certain stocks, and then I use that to line up with the mark indicators to see whether something has truly peaked, and to try to make projections on where stocks and or indices can go, and using alternative waves and measuring those both in price and time. And this is upper level stuff that not a lot of people that just look at a daily chart and say, oh, it's a buy. I mean, there's a lot that goes into some of the analysis and how you combine various methodologies to try to come up with something that can help one make money when various things line up. And so I use Elliott, I use DeMark, I use cycles, I use just traditional, trend following momentum-based indicators. That they're all extraordinarily useful and very, very helpful in investing.
I'm glad you mentioned all of those, and it's sometimes people are always looking for the magic bullet, and I don't think there's a magic bullet. You've got to use different tools to sort of one set of tools might work great for commodities, and it doesn't work well for for stocks, right? I mean, I've traded commodities, and single commodities can go much further than you could ever imagine, and then come back really painfully over a long time. But you did mention DeMark, and I just want you to have your quick little comment on it. I never really used DeMark because I didn't want to pay for it, but. That's sort of the DeMark 13s, or that's a sell. I can't remember. So can you just there's a very quick thing on DeMark.
So DeMark tools, the way I use them, are largely an overlay to prices. They tend to be sort of a confluence to just using a trend following, a momentum based system, because they give you sell signals within uptrends, which is unusual for most trend following technicians. They'll also give you areas of exhaustion during downtrends where you can choose to fight the trend. So to have DeMark tools along with cycles and maybe traditional trends, I think is really, really useful. And so, it does take some time, similar to any discipline, to really understand how they're working, how they work with regards to equity indices and individual stocks, and the time frame will all give you different signals as to a certain count. But the same principles of Fibonacci are prominent there when you use 13s, and they're based on initial 9 count, can be based on an 8, and so you have 8, 13, 21. You see the same numbers repeating in DeMark tools as you do in Elliott, and so that's really the key takeaway. Is that if you're looking to exit something that is broken out, DeMark is probably the best tool to, to try to gain, some knowledge as to where you should be selling something and take a profit in that on various different time frames. So I use it quite a bit.
I want to put you on the spot a little bit in terms of I know that you like the S&P. You think we're having a little consolidation. Not a lot of damage has been done to the charts.
Mm-hmm.
Is there a level in the S&P that below which you would say, you know what, we might be in an extended range for several months at least?
Yeah, look, it's given my discipline and methodology, it is important that a number of different things happen. It's less just about one number per se on an index. I mean, I came into this year saying these are the 7 to 8 things that are really important, where if they change, then the equity market potentially could go into a bear market. And it wasn't to say that they were going to change, it was just these are the things you need to be concentrating on. And so one was just general technical structure. Look at longer term trends of the S&P off the October 2023 lows. If that's broken, then that would give, certainly some credibility to the thinking that we're going to be starting a much larger period of sell-off. So that's the one main thing that I would always tell investors: make use of longer term trends on whatever it is they're looking at. One can use just a 10-month moving average. And if the S&P gets below that and it starts to roll over, then you want to be out of stocks. But I look at high yield. There's no dislocation in the fixed income market right now with regards to what's happening. So that's still in remarkable good shape. Breadth has rebounded, to its credit, off the January 13th lows. I always look at the percentage of stocks above their 200-day moving average, ones within, say, 20% of 12-month highs. Are those starting to show a greater amount of deterioration than the equity market is telling us? And specifically given the concentration of these stocks within the S&P, it's important to look at equal-weighted indices and look at breadth as how it's happening in the broader market, not just, the Mag 7. So breadth, seasonality, cycles. I mean, this potentially, as of the middle part of this year into next year, we do have a pretty long-term cycle that might peak out, and so it is important to make note of that. It's based on 41 months, or about 3.5 years. It bottomed in 2021. It peaked at 07 at the market highs. It peaked in 2000. It's going to show some evidence of potentially showing maybe some weakness in the back half of the year, so I want to keep my eye on that. Finally, sentiment. I mean, sentiment right now is very pessimistic, so it's a great time to be a buy and hold investor and, cover one's eyes, hold one's nose, put your hands over your ears and just buy and not worry about it. But I think that we all have to be aware that if sentiment starts to get very optimistic on a move back up above 6,600 this summer, then that's going to be a tool that one would want to use to potentially reduce risk in one's portfolio. But as a technician, by and large, I'm trend focused. So trends are really the meat of where. Sorry, it's a long answer to a very short question. But if we get under January lows in the S&P, I think I would have a degree of concern about the longevity of this bounce, and I don't think that's going to happen.
You know what? It's a long answer, but a very good answer, because, as a former sell side market maker, and I think a lot of people think about it as, where's my stop loss on something? Where do I get out? And, I think maybe people should say, well, you know what? Instead of leaving a stop loss in the S&P under the October 2023 low or the January 2025 low, you should say, leave yourself a call level, and then you want to take a look and see, hey, what's Mark thinking about this? What's Tom thinking about this? What things are lining up, because that could be an important inflection point, rather than, again, the magic bullet. Below here, I have to get out, which is something that, a sell-side market maker who needs to control his losses above everything else.
I've always learned it's helpful to ease in and out of positions and never say that you've found the exact top and the exact bottom. It's extraordinarily difficult, and it can happen, but it's wise to gradually, and that would give you a sense of comfort, unless you're stopping out a loss and you need to exit for financial reasons.
Right. And so I want to finish where we started. You were so awesome in Bitcoin. So give us the parting shot, the advice in Bitcoin for the next 6 months.
Well, it could be a choppier time, but I think enough damage has been done. I like buying Bitcoin. I think a little bit more needs to be done before I can say that we've seen a low and we're going back to highs. I think there are other cryptocurrencies that have maybe a little bit more appeal, ones like Cardano, ADA, or Solana, as it gets down to 120, or even Ethereum at 2,000. I think Bitcoin has become like a safety trade, and if we truly do get a risk-on rally, you're likely going to see Bitcoin underperform and see some of these other altcoins eventually come back to life, which could give life to like Dogecoin and things that others might find frivolous. I mean, they from a risk-reward basis, they're quite interesting after the degree of sell-off, selling pressure that we've seen in recent months. So I'm a crypto bull for this year, but I think that one has to honestly utilize risk management, use stops that are probably more important in cryptocurrencies than they are in equities. It's just so, one realizes if you suffer a 30% decline, you need to make 60% break even, and you have to. So one can make use of the options, maybe to 3/8 the orders, and try to maybe sell some calls or buy some put spreads on existing Bitcoin to help for hedging during times of falling prices. So,
well, thank you so much, Mark. Great to be here, and
my pleasure.
Looking forward to our next conversation.
Likewise, great to be here. Thank you.
Thank you.